we should discuss risk management and position sizing. I think this is something that really, really gets neglected. I think a lot of people, when they start trading, they want to learn how to do setups. They want to, how to use moving averages. How do you use support and resistance? How do you use trend lines? How to use channels? How to use patterns? How do you use volume? It's all the technical stuff I think people learn first, and rightfully so. Like, people want to make money, they want to make money quickly. But I think one of the things people learn too late is, like, actually how do you make money and how do you keep money. And I would say, just like from a personal anecdote, I would say that what took me from being just like an unprofitable trader to a profitable trader was simply just risk management. Was like having a really, really strict system of when I was going to cut losing trades for much smaller than my winning trades would be, and then just consistently being able to repeat that over and over and over again. And I would say that was where I turned the corner. It wasn't necessarily that I got smarter about, trading trends or trading reversals or trading ranges or anything like that. It wasn't like I had some new alpha. I basically just got control of myself, and I got control of my drawdown. And we can talk about some strategies for that too. But I think just, I'll read the slide. Managing risk, I think, is more important than knowing how to make money. If you can't keep the money, what's the point of making it? How many people have you met that have made millions but aren't millionaires? I think that's actually kind of a really sad anecdote. Like, I know, I'm sure you do too. I know many, 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 many people on CT and that I've met over the years on here that have, their UPNL was up $2 million, $5 million, $10 million. They bought something, when it was 10K market cap and it ran to, 50 mil, and they were millionaires, and on paper it was huge, but then, they're not millionaires now. So they knew how to take large risks. They didn't take profit. They ran up huge unrealized P&Ls, but they never took enough profit. And then, even sadly, sometimes these huge winners become huge losers because they can't get over the fact that they're not worth as much money as they used to be. They were up 5 million and now they're only up, 100K. I might as well just keep holding now. And then that 100K becomes, negative. And then that's really the sad part. And again, I think the James Wynn guy is a great example. He, talks about how 100 million isn't a lot of money, lost 100 million, and he's now asking for donations. He's trying to get people to sign up on his Hyperliquid RefLink. I just think it's really sad, and I think that's why most traders fail, is because they don't understand how to manage their risk. So let's just talk about some basic concepts. So a concept that you'll see thrown around a bunch is R. R is it's like a risk reward, R/R. So when traders are like, I'm risking 1R, the R that they're talking about is their stop loss. It's this, I like blue and purple because I hate red and green. But this is just kind of an example of, everyone's seen this. This is the long setup with the target and the stop loss. Your R is simply if your full stop loss is hit. So when someone says, I'll go to this to continue. So when someone says they're risking 1R, they mean they're risking 1% of their portfolio if they're stopped out. 1R does not mean you're risking 1% of your total capital. It will be greater than 1%. So I think that's what confuses a lot of people. When people are like, you should never risk more than 1%, people are like, well, 1% isn't a lot. Well, it's like, no, the 1% should equal if your stop loss is hit. So let's just go over some examples. So this has all been the same, target and same stop loss. So the stop loss here is 6.9% if the full thing is hit. So let's just talk about really small numbers, because actually it's really funny that I think people risk so much, because when you talk to people who are 20 years in the game, 30 years in the game, like real professionals, older adults that are are multimillionaires that have made it in the game, they risk so little, honestly, on their trades. One of my favorite traders is Peter Brandt, and he's a legend. And if you don't know him, you should definitely follow him and check out some of his stuff. But I think he's at least 80 years old. but like I think most of his trades are around, he risks 0.25% on each trade. And then you see people here that are like, oh, I'm risking like 10%, which is I think insane. So let's just talk about these examples. So this is just very simple math in Excel. Let's say all the money that you're trading with in your trading portfolio is $10,000. So your portfolio size is $10,000, and I'll keep that consistent through all of these examples. And let's say you're going to risk 25 basis points, which is 0.25%, and your stop loss is 6.9%, which is simply just what I drew right here on this example here. So 0.25% of $10,000 is $25, but your position size is $362. And basically what that means is if $362 is how much you enter into this trade, you lose 6.9%, you lose $25. So if the full 362 that's taken here at this entry goes to stop, you lose $25, which is 0.25% of your capital. And then just kind of, doubling the example, if you wanted to double your risk, you could go from 0.25% of your capital to 0.5% of your capital. Same stop loss, 6.9% right here. Your position size will double. So instead of $362 in this first example, it's now $725. So if your stop loss is hit, then you lose $50. And then you double this, you lose $100. So that's just kind of like when people say they're ramping up their risk, this is what they're talking about. So does that make sense? I'll pause here if you have any questions, because I think this is actually something that this is where I think most people who have never thought about it like this or don't actively trade like this kind of can be a little bit heady, but I'll pause for a second.
Yeah, no, this is new to me, so I'm trying to try to digest it right now. It makes sense at a fundamental level.
Yeah.
You're just adjusting. So you're just adjusting your basis against your portfolio size of 10,000, and that. Okay, okay. I think I'm seeing it here.
Yeah.
Much more methodical.
And I think this is whether you're trading in the trenches or trading perps or you're trading spot, like whatever you're doing, I really think it's essential to always be calculating what your risk is per trade. I think if you're not calculating your risk per trade, you don't know what your risk is per trade, you're gonna get taken for a ride, because it's really those losers that get out of control that really damage the portfolio. It may be one out of every 20 trades is that one, but it can really be that one trade out of 20 that just kind of wrecks the whole year. And I trust me, I've been there. I know what that feels like, and it's a terrible, terrible, terrible feeling. So what else do I have in this presentation? Okay, so this might seem like a lot, but let me just break this down. Okay, so I made this earlier today. So understanding risk per trade. So the statistics come for us all. Eventually, you will have a losing streak. It's inevitable. So this is why people don't use huge amounts of risk. Let's just start at the bottom, actually. Your percentage chance of loss. So this is if you have a 50% win rate. So I said add 50-50. So this is a coin toss. So chances that you lose the first time are 50%. That you lose 2 in a row is 25%. That you lose 3 in a row is 12.5%. You lose 4 in a row is 6.3%. That you lose 5 in a row is 3%. And that you lose 6 in a row is 1.6%. So it really, the best traders in a row will talk about this too. I think I actually heard a story where one of my kind of like trading idols, I think he said he lost 19 trades in a row. And you still have to come and have the same confidence and step up to the plate when you get your setups. But like it really can happen. So like in this example, let's say 6 in a row. So I'll be totally honest. I've been doing great the last 2 months. I'm up 16% of my portfolio. But most recently, the last 2 weeks, I've lost 6 in a row. So I am this example right now. So I've lost 6 in a row, but my portfolio is only down 1.2%. Because I'm really, really mindful of letting my losers be small. So I'm trying to lose each time I lose a trade around 0.25%. And then if I'm winning, I'm trying to amp up my size and get it so I can have my winners be much bigger. But like, let's just do an illustration. So a lot of people are like, oh, like, whatever. I only have a $10,000 account. I got to use 5%. So you lose six in a row. Like, you basically have lit 30% of your portfolio on fire. And then if you lose 10 in a row,
Mhm.
you've lost 40%. I mean, this is recovering from things like this is just impossible. I mean, in all honesty, you can do it, but it will just take so much longer. And like, extreme examples, you're using half of your portfolio. I mean, you're pretty much wiped out after 10 losing trades in a row. So it's just mindful. Like, I think the best advice for people who are new to trading is to use the smallest amount of risk as possible when you're starting, because just face it, like when you are new at something, you're going to be the worst version of yourself. Once you gain experience, you get better and better, but you'll never be worse than you are now, right? Because hypothetically, you're always improving. Every day you're getting 1% better, or that's the goal. And if you can do that, you'll be an exceptional trader. But like, I think what really helped me out was, regardless of how big my portfolio is, when I was trying to learn and try new things, I would use really small amounts of money. I wouldn't use demo, because I think demo it doesn't give you the same, like, you know, um, nervousness, and it doesn't feel quite as real. It feels a little bit more like a game. I think you have to have a little bit of pressure. But like for me, like I would use like $100. I was like, all right, my risk is $100. And if I win a trade, I'm going to bump it up 10%. And if I lose a trade, I'm going to knock it down 10%. And it would let me experiment and like without really damaging my portfolio at all. Um, and I think, that's easier said than done, because a lot of people, they want to make, they're here to make money. And they're like, all right, well, I'm smarter than everyone else. I'm gonna go do this, and then it's like they end up like these red cells is kind of where they end up. They have that, a good chunk of change, and then they just erase it. Um, so this is kind of why I certainly advocate for using smaller size when you're starting out. And then look, like we can talk about like why you would use bigger size. Maybe I'll talk about it kind of a little more now. Like if you're entering a lot of trades, let's say you're like more of a short time frame trader, you should certainly use smaller size. Um, I would imagine that your hit rate, like it probably isn't. It's probably not like that high. I mean, look, my hit rate is 39% the last 2 months, and I've been very 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 profitable, and it's been very good. And I think people that are at 50 or 60% are gods. Like if you're at a 50 or 60% hit rate, you are incredible. I mean, obviously the strategies vary. I know some people like the flow horse and people like that are like scalpers. They have pretty high hit rates because they're going for such small punts. Like going back to this like risk reward diagram, like instead of a 2.5 trade, like this guy's going for like a 1.2 trade. So he's like his stop loss, or whatever, his invalidation is pretty much equidistant to his target. And obviously the shorter that you're trying to go, like the smaller distance, it's higher likelihood that it'll happen, right? You're going for these 100% moves or whatever, 50% moves. The statistical likelihood of that happening is much less than if you're going for a 1% move or a half a percent move. But like, I think it makes sense to maybe size up more. If you just think it's a great setup, right? Like you have data behind it, it's gonna work out statistically speaking. Like you have data to back it up, then you can size up a little bit more. And I think some of the people that do that are like really high time frame swing traders. Like if you're making one trade a month or less than that, and you know exactly what you're looking to buy bottoms and ride it up for months, yeah, those guys will use a little bit more size because they're not trading that much. But if you're trading pretty frequently, I would certainly not use a lot of risk. So I hope that makes sense, and I'll open it up for questions.
I think you're very clear there. I think it makes sense. I need to I need to separate my brain between trenches and like trading, because if I set a 6.9% stop loss on every trench trade, they'd just be like evaporating constantly because
Totally.
you kind of are working with like different swings. I need to be like, okay, but this is talking about the majors and getting in there and methodically growing your portfolio by, you know, 1%, 2% a trade or something and limiting your loss. Um, it's not as pretty, but I'd probably be a lot more profitable if I it's not as exciting, but it'd probably be prettier to grow my portfolio that way.
Totally. And what I'll say is obviously you can have this is just something that I clipped in TradingView today. So this is just random. But like so in the trenches, your stop loss is going to be much bigger. So stop loss has to do with volatility. So obviously, the more volatile coins are going to be the smaller ones in the trenches, and if you have more volatility, use a bigger stop loss. So what that means is you can still risk 0.25 or whatever, 0.5%, 1%, whatever you're going to end up doing, but that just means that your stop loss will be much bigger. And if your stop loss is bigger, that means your position size will go down. So it's and like maybe I can just show you in Excel. Can you see this screen now?
Yeah.
Okay. So let's just zoom in. So this was my example. So let's say your stop loss in the trenches isn't going to need to be much bigger. So let's say it's on it. Honestly, in the trenches, it might literally be like 50%. So because right, the volatility is insane. But look, what I did by doing that is it just decreased the position size. So it could be 60%, and then your size will be smaller. 70%. This portfolio risk is always going to be static, and your stop loss simply just determines the position sizing. So it could be 20%, and then you see the size goes up, right? So that's why you see when someone is scalping and their
Oh,
stop loss is like 1%, their size is huge. Like you'll see these people that are scalping Bitcoin, and like yeah, 1% stop loss is actually probably around the range that these guys are using. So now they're using the size is 5,000, right? The portfolio is only 10,000, but they're using 5,000 of size. This is where leverage comes in. And look, I mean, look, some of these guys, like if they were like, all right, my stop loss is like 0.25%. Their position size is larger than their portfolio because they're using leverage. But the risk is always static. It just simply means that they're like getting really, really tight stops. They think it's going to go right then and there.
interesting. Okay.
Yeah. So I wouldn't be. You can totally use this system to trade trench coins. What I will say is you should always know where you're going to get out of a coin from a profit and a loss standpoint. Like I think you should always know when you take a trade, you should write down in a journal, in Excel, in a Discord, on a paper journal, wherever suits you best. All right, where is this wrong? I know I'm going to cut this if this happens. And you can, in TradingView, or I think even DexScreener too, if you're doing trenches, you can have an alert sent to you where it's like alert, ping, like, okay, now I have to go to my computer and close this trade because it was hit. I don't have to think anymore. I wrote down the invalidation ahead of time. Now that it's hit, I'm just going to get out. I don't have to, be harsh on myself. I'm just following my system. And that's how I trade. I literally, if you look at my charts that I post in the professor channel, like I'll always write a line that has an alert that just says invalidation. And I know immediately that if the thing touches my invalidation line, I'm just going to close the trade. I don't even think about it. Even if it bounces off the line and goes back into profit, I'm like, no, this wasn't what I wanted to see. If it goes back into profit after I close it, I'll just take the trade again. I'll just open it again. It doesn't matter. But it takes a lot of the thinking out. Like if you're thinking live about a trade being wrong, you're going to lose because your emotions are there. You don't want to lose money. You don't want to take a loss. You don't want to add to your loss count. You don't want to decrease your win probability. All those emotions come in. So you have to set your plans when your head is straight and you're thinking clearly. And then when shit hits the fan and things have huge sell-offs, like you're getting out because you already made that plan. And look, it takes this is the hard, this is why most people aren't profitable because this is hard. This is actually the hard stuff. Is being disciplined, having a system, and sticking with it.
Makes sense to me.
Yeah.
Lord knows I need more discipline in my life.
Yeah, and it's something you never really master. Like I understand these things and I've gotten much better at them, but like I mean, there's this that's what's fun about this game is you never master it. No one ever like, beats the game. Even if you're the best trader in the world, you won't always be the best trader in the world. Um, it's a never-ending competition. So, that's why it's so fun.
Right? Always room to improve.
Always room to improve. Well, dealer, I appreciate you joining, man. If there's no other questions, I'm going to wrap it up here.
Thanks for the lesson. I appreciate it, and I'm gonna take it to heart.
Cool. And I'll publish it, and you can rewatch it, or if any of your friends want to watch it too, we'll make it available for everyone.
Perfect. And if any of us ever run it up like James Wynn does, we gotta have hold each other accountable. Okay.
Yeah, you have to take profit. I mean, that guy was up almost 100 million and didn't take any profits. It's ridiculous. It's like that you could cure starvation in a third world country with that kind of money. It's like you could solve a lot of the world's problems. But instead he's now begging for money because he has none left. Pathetic.
That's outrageous.
Yeah. Well, on that note, we can strive to be better than that at least. So, I'll see you later. Have a good one.
Talk to you later. Bye.
See ya.